Okay, now we're going to talk about how do we calculate financial freedom. And this is an exercise that I go through with every client. And it's really simple, but it's something that nobody really thinks about much. And I've never ran into anyone that actually has done this before we got together. So here's the way I look at this. And basically, the question that I ask is simple. It's how much does it cost to be you? And so with that, we add in, housing, cars, vacations, health insurance. Just the list just goes on, just everything. And then I always like to ask the question of, are you living the way you want to live? Like, are you living at the ideal, what you want? And a lot of clients, it's like, yeah, we're living exactly what we want. If you are, that's great. If you aren't, we need to add that factor to this as well. But let's just say, for argument's sake, that all of this added up to 230,000 roughly. I'll usually then ask, are you taking, is this the vacations? This is everything. Would you like is there any emergencies that cropped up in the last year or two? Like, I'm trying to get them to understand that, okay, this is all the known. What is it that they really need? And it might end up that we round it up to 250. And sometimes I'll be like, also to clarify this further, do you have any, is this including a lot of things that are going to go away in the near future? Like if they have kids in college or, marriages happening on the horizon, whatever. So is the number going to go down in the near future or is it going to go up in the future? Whatever's going to happen. But what we want to do is get it to a number. So let's say it was at 230, but then we find out that there's no room for, emergencies and they've got a new grandson or baby coming up and a wedding. We may even take the 230 and just to be comfortable, make it 275 or even 300. So in this box, let's say we went all in and they had a lot of things coming up in the near future and in the long-term future. We ended up that their known expenses were 230, but with everything all in, it is $300,000 to be them year in and year out. Now, what we do from there is figure out how to replace that number. And so we're going to move on to how do we create, in this case, we had $300,000 is what it costs to be them. Now, if this was after tax, we would have to make it before tax or more tax efficient to where the net, what I'm getting to is that the net needs to be 300 grand. Now, we're going to look at the two ways that most people look at creating the 300,000 of perpetual income. Well, first of all, many people don't ever think of in terms like this. This is very simple, but simple doesn't mean it's normal. What I'm saying is a lot of times regardless of success level, I've never had a client go, oh my gosh, like, we've already thought of that. We know how we're doing it, etc. It's not common practice is what I'm saying. So think of it like this. There's two ways that you can create, two big global ways. One is to save and invest, I guess would be the best way to think of it. Save and invest your way to a point where you have enough in savings that the savings generate the 300 grand a year. Now, again, I'm doing this super simplistic. We're not factoring in taxes and so forth, which may actually drive it higher, which is fine. We just plan with that. But think about it like this. I always like to do a simple calculation. 300 times 20 is $6 million. Okay? What does that mean? That's this plan. 6 million. Get to 6 million, you can pull off, essentially, if you could earn net 5% per year, interest alone would produce the 300,000 and not touch the principal. Now, what are the flaws with that? Number one, it doesn't tackle inflation, which is a huge issue, meaning this 6 million is losing value every year because of inflation. In 20 years, 6 million would lose, if they only earned the 5 to, what would they, at 3%, they'd lose 60% of that value. Just saying. Not being negative, just saying we haven't factored anything for inflation. What I'm saying is 6 million would create the 300,000 like clockwork. The other point on inflation, though, is that this 300,000 number will continue to rise as well. Why? Because of inflation. So each year it's going up and up. In other words, in 20 years, you would need 60% more dollars, or 160% of 300,000. So to equal 300,000 in today's dollars, it would be substantially higher. So we're not figuring that. We're just trying to get to a freedom number right now. First way, this is how 99% of advisors think, it's to save to 6 million and have it set aside to create this income. If you do that, that's great. What is the problem with it? It takes a lot of time. And what's the other big problem? It's your money. You have to save money after you pay taxes. So this is like you earn money, you pay taxes, you live, and you've got to save, and you've got to get to that number to get free. And for a lot of people, that's almost impossible. It just keeps getting away from them. So what I'm going to talk about now real quick, again, this is a quick overview of financial freedom, is what's the second way. So this was number one. Number two would be, instead of save and invest, create. The income. How would you do that? Well, number one, and again, we're trying to do this to where we're not, like, the essence of financial freedom is that you have broke the time for money trap, meaning you do not have to be present for it to show up in the mailbox, if you will, or in the bank account. So the second way would be create income. How would you do that? You could do real estate. So you could buy rentals. What's great about real estate? You can use the bank's money. Most of it, the purchase would be in the bank's money. And with that, you're trying to use, you just want to focus on cash flow. What do I mean? Money comes in for the rent, money goes out for the mortgage, taxes, and all that. You want to make sure that it's positive from day one. If that's the case, you don't care if the house goes up and down in value, which it will, you are good to go. And when the appreciation buyers are going bankrupt because they're over their head, you will still be whole and be buying their houses for more real estate. That's one way. Another way would be something like, say, network marketing. You know, create an organization, build it up. I've seen a lot of people do that. That's, again, a passive income source. Another way would be, buy business interest or build business interest. Meaning it's a business, you're not required to be there. Again, time for money trap. And it pays you income, passive income. Another way would be licensing. Either your own or someone else's great idea or product, and you create a licensing contract and put it out there into different markets, whatever. And I'm just covering broad-based things, but this is some things to think about. There also are some insurance programs where you can use the bank's money to fund them, and they create a bunch of money and they will create income. Again, we're getting away on number two from it being your money that has to fund, or your time from having to fund creating this freedom. Okay? So really simple. Now here's the beauty. Do you have to pick number one or number two? What if you could just do both? A little bit of both. Maybe 50-50, maybe half, 30% save and invest, 70% create through alternative programs. The thing is this, and this is something that's super important that a lot of people never understand because it's not mainstream. You know what it is? It is easier to do number two activities to create 300 grand in income, perpetual, than it ever will be to start from scratch and save $6 million. Again, to get $6 million, you would have to earn, with our tax system, anywhere from 10 to 12 million and save every penny because of taxes. And when you subtract out lifestyle, everything else, it takes time, a lot of time, to get to this point. That's why they say traditional planning can take 40, 50, 60 years, where this right here, with a smart real estate portfolio and some different other things going on, 300 grand could be done in a matter of 3 to 5 years. At the long end, 10 years. But you have to think, I guess the old saying, think outside the box, or you'll have to live in the box, which is over here. This is why most people don't ever, it isn't the fact that they can't do this program. It does work if you live long enough. The problem is, for a lot of people, they give up on financial freedom because it seems it's almost unreachable. But when you combine doing number two with this, then it all, like, you can see the light at the end of the tunnel. Now, a lot of my clients, they've got the pedal to the metal like there's no tomorrow. And I come to them and I show them something like this, and I already know they are well beyond needing to create any income because their assets, instead of 6, might be 40 million. But you know what? They've never done this exercise, so they've never thought of it in terms. They just, if they love what they're doing, that's one thing, which a lot of them do. But if they're doing it like their life dependent on it because they're afraid they may someday run out of money, which a lot of business folks have that beat into them because of the lean years, the first 10, 20, 30 years they were in business. And they're full throttle when they could be just enjoying their life at this point. By doing this simple little exercise, you can determine where you're at. Okay, so now we're going to cover what I call the 3 pillars of wealth. And it took me almost 25 years in the financial business and working with very high net worth clients. The last 10 years, it took me about 5 years of working with mega clients to figure out the 3 pillars of wealth. It isn't anything I've ever seen in any book. It was just me surmising everything I'd read, seen, studied, worked with, built strategy for, whatever, of people that have extreme levels of wealth. What 3 things do they do that no one else is focused on? And so that's what the 3 pillars of wealth, that's where they came from. So here it is. Number 1, tax reduction. Number 1, above and beyond everything else. Every wealthy, and I'm talking wealthy, over 50 million, over $100 million person that I know and have worked with and studied, tax reduction is number 1. I might have an idea for them. The first thing I want to know is, John, tell me the tax consequences. What is the tax angle? And if that makes sense, then we'll talk about whatever the idea is. If not, they're not interested at all. Why? Because they make taxes the determiner of what they're doing next. And the tax code will lead you right where you need to go. Not going to get into that now, but it's a great guidebook. Number 2, assuming you have tax reduction maxed out, regardless of how high your income is, that you're paying little to no taxes, then, in fact, before I get to that, I want to just give you this. Tax reduction. It's not just, we'll defer it. Deferral is not tax reduction, it's tax deferral. I'm talking about actual programs that reduce or eliminate taxes. And I want to say this with the tax code. What does it want us to do? Create money, housing, business, or any combination of those. And you could even add protect environment. And there's others, but there's a list there. If you just do multiple things in each of these areas, like how do you create money? Through loans. 97% of all money is created through loans. So you take a loan on a house, you don't pay taxes on the loan amount, and you get a deduction for the interest. How crazy is that? Why? Because you're doing what the government wants us to do. Housing. You do rental properties, you get 4 crazy tax advantages. You start a business or invest in a business, tax advantages. Protect the environment, conservation easements, great tax incentives. So let's say that you've got that all figured out. What's next? Leverage. Leverage is the difference between owning a house and owning 1,000 houses. That's what it is. It's the difference between being rich and being poor. There's a million different ways to get leverage. The most common are through people. That's why you have a business with employees. Financial, that's how you buy houses, cars, and so forth. And leverage, leverage can be good, leverage can be bad. When it's good, it's used to buy stable investments, such as real estate, such as there's insurance programs that are fully insured. They don't have a downside. They're not risk, or they're risk built-in risk protection. So they're safe. What you don't want to do with leverage is go take a loan from a bank and put it in something that could lose, or that has a high potential to lose money. I mean, none of us have a crystal ball, but to go jam a bunch of money in a stock that could go down tomorrow is a little different than buying some real estate that you studied, so you knew that the cash flow was good no matter what the market was doing. That's how you do it. That's the difference. So let's say you have leverage versus non-leverage. Leverage means you're buying, I always think of it like this. You're either trading your dollars for pennies or trading pennies for dollars. What do I mean? If you can buy $1 for 4% interest per year, you're trading 4 cents to control $1. Compare that to putting your money in the bank and earning 3 cents or less on your money. They are doing the opposite of you. They're taking your money, they're reinvesting. You are accepting pennies, but they're using other people's money. So what I'm teaching you here is how to mirror the biggest entities on the planet, which are the banks, which are the governments, which are the Fortune 500 companies. This is exactly what they do. So what's the third? Passive income from multiple different places. So you reduce your taxes. So this could be houses, like real estate. It could be multiple real estate holdings. It could be business interests. It could be licensing, all the crazy things. There's a million ways to build different passive incomes. But the cool thing in today's world, and this is modern wealth, is once we went off the gold standard in 1971, the money became monopoly money. The government didn't tell us this, but they made it, crazy not to use the bank's money to go buy assets that pay every month, such as business interests, such as licensing contracts, such as real estate properties. And when you have, here's the all of this in a nutshell, and you totally understand the 3 pillars of wealth, it's not whether you're going to be wealthy, it's just how wealthy you're going to get. Are you going to create generational wealth? You can do it with the 3 pillars of wealth. You cannot do it with traditional planning, because traditional planning, this may shock you, ignores all 3 of these and leaves you on your own to figure them out. In fact, traditional planning even kind of, dismisses these if you mention these are the ways that you want to build wealth. They can become very dismissive because they For somebody that's middle class, let's say, no problem with that. But this type of thinking really is for those that are ascending up into the upper class, that are beyond the day-to-day needs of, financially, they're well beyond just trying to build a little bit of savings. If you invest in real estate properties, that's long term. Even investments in the Wall Street, long term. Everything's long term. But the point that you've got to understand, whether you're worth zero, whether you're worth 10 million, whether you're worth 500 million, this right here, once it begins, it never ends. Your income and assets become the attractor for banking, money. So cheap money. Right now, it's just getting cheaper by the day. That's what creates the leverage. But again, key point as well. If number one isn't solved with advanced planning that really tackles all of this all the time, none of the other two matter. Tax reduction has to be primary. Once that's fixed, leverage, passive income. Build it and build financial freedom, not only for yourself, but for your heirs. The beauty of passive income, a lot of the assets that you buy with this leverage, the houses and so forth, they pass to heirs if you want, and they get the step up in tax, but there's not even a tax cost, even as it transfers from one generation to the next. Try that with your 401ks. Doesn't happen. So anyway, that is the 3 pillars of wealth.